The White House reportedly developing a plan to cut taxes by adjusting capital gains to inflation. Now, Bloomberg says the proposal would be done in a way that bypasses Congress and takes effect before President Donald Trump faces re-election in 2020. Hillary Vaughn is at the White House to explain exactly how the tax break would work for investors. Hillary.
Hey, Charles. Well, the president has hinted that he has wanted to do this for quite a while, and the vice president's chief of staff, Mark Short, telling me that he does think that capital gains should be indexed, but says that conversations to push this through are really in the infant stages right now, and he hasn't talked to the president directly about it. But reportedly, White House officials are on a tight timeline because they want to push this through before the 2020 election so that the impact and benefits of this hit before the president faces re-election in November. So indexing capital gains would slash tax bills for investors when they sell stock or real estate by adjusting the original purchase price so no tax is paid on appreciation tied to inflation. Critics of the idea say it mostly benefits the 1% and it could push investors to sell. And part of the plan reported by Bloomberg is that the White House would try to push this through executive order, but there are concerns that that could face some legal challenges down the road. The reason why that's considered the best way to get this done is because the White House is expecting pushback from Capitol Hill, especially from Democrats in the House that have already been critical of tax cuts that tend to favor the 1%. And so this, of course, would not be something that they would like. But I want to take you down memory lane to 1992 in February, when then Congressman Chuck Schumer was on the House floor actually advocating for capital gains to be indexed to inflation because he spoke at the time in favor of it, saying it would push forward economic growth. The House voted on that as part of the tax package, essentially, that was also taken up in the Senate and then sent to the president's desk. Joining Chuck Schumer in voting for this amendment that had capital gains indexing was Nancy Pelosi. So we'll have to see if they have a change of heart now, but certainly a couple decades ago, they didn't have a problem with it. Charles?
Wow. What do you know? Hillary, thank you very much. Well, revamping capital gains taxes by bypassing Congress with an executive order will obviously face some legal challenges. But Trump's economic advisor, Larry Kudlow, is a proponent of the policy and says that it would spur job creation and economic growth. I want to bring in Edward Jones's investment strategist, Nela Richardson, and Capital Wave strategist, Shah Gilani. Nela, let me ask you about this. I mean, as someone in the market, it must sound somewhat appealing. Net would it have a positive impact on all of society?
You know, it's too soon to tell, but what we know is that it sets a precedent of tying a tax benefit to inflation, which hasn't been done before. And when you think about a tax policy issue, it's really about incentives. So while more investment is a great incentive, we have to understand whether this particular policy leads to more investment, first of all, and how much does it cost, second of all. Until we answer both of those questions, we really can't ascertain the value of it.
Sure, I think it was 1969. There was maybe 10 people who hadn't paid taxes. An article was written, and soon we had an AMT. It wasn't indexed for inflation. 2 decades later, hundreds of thousands, perhaps millions of Americans were paying this onerous tax. So the idea of indexing a tax to inflation seems to be smart in a lot of ways.
Well, I've never met a tax cut that I didn't like. This one may be an exception in terms of at least the timing of it. I don't think it's time for the president to pull this out now, and certainly not to do it by executive order. I think that's going to just give some fodder to the Democrats to go after the president as being beholden to the 1%. And I don't think it's the timing is good. I'm not sure it's such a great idea anyway. Again, I like tax cuts pretty much across the board. However, this one seems to be a bridge too far for me.
All right. Hey, let's shift to this record-breaking month for the markets. The S&P 500 on track for its best June since 1955. The Dow, its best June since 1938. We have mixed messages today, but some very important economic data out. Nela, consumer sentiment was better than anticipated, and the only thing holding it back was the talk of tariffs. And that, ironically, that hurt the top 1/3 of household incomes. In the meantime, income was up, spending was up, savings rate 6.1%. That seems like perfect. That's what you want. You want incomes up. You want people to spend it, but not all of it, save some of it. But the Chicago PMI, it's a manufacturing number. It went to contraction. And the big national numbers on Monday, I believe if we see that happen again, that will be enough for the Fed to to really start maybe thinking about 50 basis point cut. I mean, what do you think?
You know, Charles, that's exactly right. All economic data is now through the lens of whether or not the Fed will cut rates right now in terms of the markets. But look, consumers are 70% of the economy. Manufacturing is 20% of the economy. So when I have a bet to make, I bet on the consumer. And we've seen consumer spending hold, and we see a very tight labor market. We're seeing steady wage gains. So those conditions are in place for the consumers to keep spending, keep supporting the economic expansion, and that's a good support for equities to climb, we think.
Shah?
Well, I don't think there's a reason for a cut of 25 basis points, and certainly not a 50 basis point cut. The consumers are doing very well. Spending is under control. And I think the only thing that we're afraid of is the fear itself that perhaps a one-off PMI number from the Chicago ISM PMI might be indicative of the whole economy going down some hill. I don't believe it. I don't see it. I think consumers are in great condition, great shape. Spending is, again, as we touched on, under control, and confidence is still high. So I don't see any need for a cut.
I got less than a minute, but I've got to ask both of you. If the headline is truce on Monday with this meeting between Xi and Trump and the negotiations are back on track, what does that do for the market?
It means that all those traders can go on vacation and sleep well at the beach. But you know what? This is
Shaw's already there.
This is not a quick one and done. Whatever happens over the weekend, expect more to come because this is a complex deal. The markets have to anticipate some longevity in these negotiations.
Shaw, is that why you're already at the beach?
I'm anticipating a standstill between the two leaders, and I don't think anything is going to happen in terms of the market. Barring some saber rattling and some negative commentary, the market's probably going to just stay the course and trade sideways for a while until we get some clarity on actually what might happen in terms of a final negotiation.
All right.